Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of strategic financial management, we continue with the discussion on swaps. In the previous class, we started the discussion with interest rate swaps. The moment I displayed the title of the class as interest rate swap, I have mentioned one thing. Interest rate swap is also known as generic swap or plain vanilla swap. The moment I say plain vanilla swap, students ask me that, sir, do we have a swap which is not a plain vanilla kind of, that is a flavored swap? I said yes, we definitely have a flavored swap which we are going to discuss little later. Time has come for us to discuss those flavors, and that is covered under concept number 13. Technically, it is not called flavored swap, it is basically currency swap. But I would definitely call it a flavored swap. Why a flavored swap? If you can recall, under plain vanilla swap or interest rate swap, there was only swapping of interest between the two parties. Correct? We have seen that. Under a currency swap, the biggest point that you will find is it is not just swapping of interest, but even swapping of principles. The moment I say this line, I am sure you have yet another question in your mind that, sir, why there is a need to swap the principles? So what I will do is, I will first take up a scenario so that you understand why there could be a need of a swap like a currency swap, where not just amounts of interest but even the amounts of principal would have swap. And for this purpose, a fantastic question given in your textbook as question number 28. Let us read this question and let me expand the screen size for your reference. NJ Limited is an Indian company having a subsidiary in US and is looking to raise $1 lakh for funding its subsidiary. It can borrow at the following rates: dollar loan at 8% and rupee loan at 12%. CB Limited is a US based company having a subsidiary in India and is looking to raise rupees 50 lakhs for funding its subsidiary. It can borrow at the following fixed rates, that is dollar loan at 6% and rupee loan at 15%. The current spot rate is $1 equals to rupees 50. Show how a currency swap would work in the circumstances described, assuming swap is only for 1 year and that interest is paid at the end of the year concerned. Now friends, when you are reading a question like this, what you exactly need to understand over here? The question is talking about two different companies. Both the companies find that the subsidiary company of the counterparty is requiring a loan in the currency of the other company and the amount of loans required are equivalent. So how does this plan up to a currency swap? So why there is a need for a currency swap, that fundamentally we should discuss first. If you carefully look at the interest rates given over here, imagine NJ Limited, which is given as an Indian company, if it has to borrow in India locally, it can get the best interest rates from local banks over here. However, it will not have such a great reputation when it has to borrow in the US. Likewise, the other company, that is CB Limited, which is a US based company, if that company needs to raise a loan in the US itself, it will get best possible rates because that company is a US based company and it may not get very good rates in India to borrow in Indian rupee. So problem is, the subsidiary of the US based company is in India and that subsidiary is requiring funding in INR. The subsidiary of Indian based company is in the US and that is requiring funding in the USD. Now just imagine if NJ Limited and CB Limited they come together and they decide for a currency swap, it could be a beautiful arrangement where NJ Limited will borrow in India locally in Indian rupee value a sum of rupees 50 lakhs for 1 year. Simultaneously, CB Limited shall borrow $1 lakh in the US, and that amount will be denominated in USD but having equivalent value to rupees 50 lakhs. Now, NJ Limited's subsidiary, which is operating in the US, requires funding in USD. So what NJ Limited would do, NJ Limited would request CB Limited to transfer that $1 lakh of USD denominated loan to its subsidiary. And as a counter arrangement, NJ Limited will transfer rupees 50 lakhs of loan to the subsidiary of CB Limited, which is operating in India. So basically what happened, I wanted to fund my subsidiary. I am NJ Limited, of course, in this case. I hope you had been tracking one thing, that throughout the learning of financial management, NJ Limited is nothing but me. So I am trying to fund my subsidiary, but I have best rates available if I am borrowing in INR, but my subsidiary requires funding in USD. What I did, I arranged borrowings in INR, and which I have basically arranged for the subsidiary of CB Limited, which is operating in India. As a counter arrangement, CB Limited has given $1 lakh of funding to my subsidiary, that is NJ Limited subsidiary, that is operating in the US. Now what is happening? I have literally gone for a currency swap. That means NJ Limited and CB Limited, they have swapped the principal amount of borrowings. How can we say that they have swapped the principal amount of borrowings? Let me explain that. NJ Limited borrowed rupees 50 lakhs in India. Finally, what has happened, through routing this fund via CB Limited, CB Limited has forwarded that $1 lakh of loan to the subsidiary of NJ Limited. So NJ Limited borrowed rupees 50 lakhs. The equivalent value of that loan in USD finally reached its subsidiary. Likewise, CB Limited borrowed $1 lakh, but the equivalent rupee value of that loan, that is rupees 50 lakhs, finally reached its subsidiary. If this was not arranged, do you know what would have happened? CB Limited would have borrowed in INR at a higher rate, that is 15%, and NJ Limited in the US would have borrowed at a higher rate, that is 8%. Why to pay 8% when a loan can be arranged at 6%? Why to pay 15% when the loan can be arranged at 12%? So, in order to have benefit for both the parties, it will be advisable that the companies do not borrow in the required currency, they instead borrow in the opposite currency. For example, NJ Limited actually needed USD loan for its subsidiary, but it did not borrow in USD, it has borrowed in INR. CB Limited actually needed INR loan, but it did not borrow in INR, it has borrowed in USD. So, NJ Limited has actually swapped its loan with CB Limited, that is the principal amount got swapped. One thing good about this kind of arrangement, between the two countries, India and the US, not a single penny of remittance would ever happen, because the Indian rupee loan that NJ Limited borrowed from local banks in its own name was actually transferred to CB Limited. That means Indian rupee loan, actually that money remained in India. Parallelly, same thing happened in the US. CB Limited borrowed $1 lakh, and that dollar loan, it has handed over to the subsidiary of NJ Limited in the US itself. As a result, the USD loan, that money remained in the US, the INR loan, that money remained in India. There was no remittance between the two countries, but still the principals were exchanged, the principals got swapped. So let me explain this whole thing by a little better arrangement in terms of viewing this. So just keep paying attention over here on the screen. So please try understanding the scenario. The two companies, NJ Limited, Indian based company, and CB Limited, US based company. CB's subsidiary is operating in India and NJ's subsidiary is operating in the US. Now NJ's subsidiary is requiring funding of $1 lakh. Of course, it will be the responsibility of the parent company to provide that funding to the subsidiary, and on the other side, CB Limited's subsidiary that is operating in India requires funding of rupees 50 lakhs. So what is happening in this currency swap arrangement? CB Limited, which is US based company, it is borrowing $1 lakh locally in the US and transferring that money not to NJ Limited but to NJ Limited's subsidiary. Now what has happened? The US dollar loan that was raised by CB Limited, that money remained in the US, but eventually from CB Limited that money got transferred to NJ Limited's subsidiary. As good as CB Limited has given its $1 lakh value to NJ Limited. Now what is the counter arrangement that NJ Limited has to do in India? NJ Limited in India will borrow rupees 50 lakhs locally and will hand over that amount to the subsidiary of CB Limited. As a result, CB Limited's subsidiary finally got rupees 50 lakhs which it required. And look at one thing now, 50 lakhs of loan that NJ Limited has raised in Indian rupee, it was having the objective to get this amount reach to its own subsidiary in the US, where the equivalent value of $1 lakh is exactly rupees 50 lakhs. That means when NJ Limited has borrowed rupees 50 lakhs, it could finally fund its subsidiary by an amount of $1 lakh without remitting a single rupee or single dollar from India to US. And similarly, CB Limited, when it borrowed $1 lakh locally in the US, finally it could fund its own subsidiary in India a sum of rupees 50 lakhs through this currency swap arrangement. So this currency swap arrangement, what we are finding over here, I am going to talk about this a little more, but before I do that, please write up this arrangement so that you get that understanding very clearly. Alright friends, I am sure you would have written this whole thing. Now let me explain what would happen after this arrangement. So there will be two stages. One will happen at the beginning of the year. So at beginning of year, what happened? Both the companies, they borrowed locally from their own banks, that is local banks within their country, and they have handed over the money to each other. So NJ Limited has literally given rupees 50 lakhs to CB Limited and CB Limited has given $1 lakh to NJ Limited. So don't you observe over here that there is a swapping of the principal amount of $1 lakh against rupees 50 lakhs already happening. But as I told you, there is no remittance of any money between these two countries, that is India and US. Now what? At the initial stage, two things happened, right? The two companies borrowed locally and they have swapped the principals. NJ Limited gave away rupees 50 lakhs to CB Limited, not by transferring that money from India to US, but handing over that money to CB Limited subsidiary, which is anyway operating in India. Likewise, the other arrangement was made by CB Limited by funding NJ Limited subsidiary in the US itself. So both the companies, they borrowed locally and they swapped their principals. That happened at the beginning of the year. What will happen by end of the year? NJ Limited has borrowed rupees 50 lakhs. It will pay interest on that 50 lakhs at 12%, because bank which has given loan to NJ Limited has nothing to do where that loan was actually utilized, to the extent it is getting its interest and repayment of principal on time. Correct? Now, this amount was actually given to CB Limited's subsidiary. What was the benefit of CB Limited over there? CB Limited itself could have arranged that Indian rupee loan at 15%, but because of the arrangement made via NJ Limited, the loan was availed only at 12%. So logically, the burden of interest of Indian rupee loan would fall upon CB Limited, or you can say CB Limited's subsidiary. Likewise, the burden of dollar loan would actually fall, in terms of interest burden, it will fall on NJ Limited. So by end of the year, NJ Limited will pay 12% of 50 lakhs, that is rupees 6 lakhs as interest on that loan to the local banks in India. Knowing that this it is paying right now on behalf of CB Limited, and it will get the reimbursement of that 6 lakhs. Likewise, what will CB Limited do in the US? It will pay 6% of $1 lakh, that is $6,000, to the bank from which it has borrowed $1 lakh. So the interest payment will be made by CB Limited locally to its bankers over there in the US, that is $6,000. But knowing that this amount CB Limited will get as a reimbursement from NJ Limited. So first thing, what will happen by end of the year? Both the companies will pay interest to their local bankers. Secondly, there will be swapping of interest also, and because the tenure of the loan was only 1 year, after completion of all this, there will be a swap back of the principal, so that the whole arrangement can finally come to a close. So let me give you those additional steps and those calculations, and at the end what I'll show is, one thing will be the process of this currency swap from the beginning till end, and finally which company got benefited by how much value. Both of these points in your solution, let me explain over here so that you can note it down. So the solution will be presented in two parts. The first part would indicate the time wise flow of all the transactions and events, and now we have two companies, NJ Limited and CB Limited, and when we talk about timing, we begin from now. Now here stands for the beginning of the year. So what has happened at the beginning of the year? Both these companies, NJ Limited and CB Limited, have borrowed from their bankers. NJ Limited borrowed rupees 50 lakhs at 12%, and CB Limited borrowed $1 lakh at 6%. And why did they borrow these monies is the question, right? NJ Limited wanted to fund its subsidiary, and what we have arranged over here, that CB Limited will actually fund NJ's subsidiary at this rate 6%, and to do the reverse favor, NJ Limited will fund CB's subsidiary at this low rate of 12%. That is why we say in the next step they are going to exchange principals. So NJ will pay rupees 50 lakhs to CB, and CB will pay $1 lakh to NJ, and therefore in this step of exchange principals, NJ would pay rupees 50 lakhs to CB and receive $1 lakh. So here the loan has been swapped, the currencies have been swapped, and what CB will do, CB will pay $1 lakh to NJ and receive rupees 50 lakhs. We have already seen that how this will work once again let me tell you, NJ will pay rupees 50 lakhs to CB, not actually to CB in the United States, but to CB's subsidiary which is operating in India. And when we say that NJ Limited received $1 lakh, it will not receive this $1 lakh as a remittance in India. It is NJ's subsidiary in the US that will receive on its behalf this sum of $1 lakh from CB, and vice versa thing happening with CB Limited in the US. That is how the exchange of principals take place. It is basically this step that we call as currency swap or swap of the principals. Now, end of the year, what will happen? Both the parties will pay interest to their bankers, and NJ Limited will pay rupees 6 lakhs interest, that is 12% of 50 lakhs, and CB would pay $6,000 as interest, that is 6% of $1 lakh. Now both of these interests are not paid from their own expense viewpoint. Basically NJ has paid this interest on this rupees 50 lakh which was actually utilized by CB's subsidiary. That means NJ has incurred this expense on behalf of CB's subsidiary, and likewise CB Limited has incurred this interest expense on behalf of NJ Limited's subsidiary. And that is why in the next step what both these companies will do, they will even swap their interest. So exchange of interest or swap of interest would take place as the next step. So what NJ would do, NJ would pay $6,000 to CB and receive rupees 6 lakhs, and what CB would do, pay rupees 6 lakhs to NJ and receive $6,000. At the end of the year, one more thing is going to happen, because the arrangement of swap has ended by end of 1 year. This step, what you have written as exchange principles, there will be reversal of this step. So we call that as swap back principles, and that would be reverse of this step, right? So this step was pay rupees 50 lakh and receive $1 lakh. Here it will be reversal, pay $1 lakh to CB and receive rupees 50 lakhs. What CB will do, pay rupees 50 lakhs to NJ and receive $1 lakh. So friends, time for you to take note of this whole thing, and then we move ahead.
Alright friends, after writing this whole thing, let us move ahead and compute the benefit that would arise in the hands of each of the two companies. Now, without swap, what would have happened? NJ Limited would have borrowed at 8% to fund its subsidiary, correct? And CB Limited would have borrowed rupees 50 lakhs at 15%. These could have been their interest expenses. But because of swap, what is happening? NJ Limited's expense is finally $6,000 and CB's expense is only rupees 6 lakhs. So they both have saved substantially in their interest cost. And this is how both the companies have been benefited from this currency swap arrangement. Note down this as well, and that will be end of the solution.
Alright friends, once you have completed writing the entire solution, let us move ahead and take up another question, that is question number 29. Let us read this question. A Inc. and B Inc. intend to borrow $2 lakhs and $2 lakhs in yen respectively for a time horizon of 1 year. The prevalent interest rates are as follows. If A company is borrowing yen loan, the interest rate will be 5%. If A company is borrowing dollar loan, the interest rate will be 9%. If B company is borrowing yen loan, the interest rate will be 8%. If B company is borrowing dollar loan, the interest rate will be 10%. The prevalent exchange rate is $1 equals to yen 120. They entered in a currency swap under which it is agreed that B Inc. will pay A Inc. at the rate of 1% over the yen loan interest rate, which the latter will have to pay as a result of the agreed currency swap, whereas A Inc. will reimburse interest to B Inc. only to the extent of 9%. Keeping the exchange rate invariant, quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. So first of all, over here, what is given, if you carefully observe, here the arrangement is again a simple arrangement between the two companies A and B. So both the companies require equivalent amount of loan, where the value in US dollar, if you compare, it is $2 lakh, but A company requires loan in dollar itself, whereas B requires loan of the same value but denominated in yen. So both the companies can borrow at different rates depending upon what loan they are raising for themselves, which currency loan they are raising for themselves. So in that earlier example of strong limited and weak limited, which you have done in the previous class, if you can recollect, strong limited had a better credit rating compared to weak limited, and they both wanted loans at different interest rate arrangement. One wanted a fixed rate, one wanted a floating rate. So there we have explored two options. One was with swap, one was without swap. If without swap is better, then let them borrow at their required arrangements. If with swap is better, then let them borrow at the counter arrangement, that is the arrangement that actually they don't want, but then swap it with the other company. Here exactly it is a similar case. The only difference is here it is not just interest rate swap, it will be a currency swap. So if you focus on this scenario, A company wants loan in USD, that is the loan has to be denominated in USD. B company wants same amount of loan, but the loan amount should be denominated in yen. Now both these companies also have two alternatives. One is without swap, another is with swap, depending upon what is going to be beneficial. So if A is raising loan in USD currency, then there is no need to swap because it actually requires the loan in USD. And B is raising loan in yen, then no swap will happen. So first possibility is both the companies are raising loan in their own required currencies, so there will be no swap. You look into what is the overall interest that they will end up paying, the way we do in interest rate swap, same way. The overall aggregate interest you have to compare for the two companies taken together without swap and with swap. Under a with swap kind of arrangement, A company will actually borrow in yen and B will actually borrow in dollar, and then they are going to swap the principals. So whether currency swap is beneficial or not, first you will have to show that, and then the usual process of swap will happen and you will again compute the final differential as a benefit to both the parties. Now that was one thing that you will have to do additionally in this particular question. Second thing, previous question, if you see, NJ Limited got a benefit of 2% because the loan rate in the previous question, the borrowing rate in the previous question for NJ Limited in USD, for borrowings to be raised by itself it was 8%, but borrowings to be raised via CB Limited it was 6%. So NJ Limited actually saved 2%, but CB Limited effectively saved 3%. There can be a kind of a point between the two companies, that why should one end up saving just 2% where other is saving 3%? Why not the savings also to be brought at parity? That kind of objective these two companies must have planned in this case, because they specifically gave you who will reimburse how much interest to the counterparty. So if you can recall, there are 5 steps in the currency swap. First, both the companies will borrow locally at their own banks. Second step, they will swap the principals. Third step will happen by end of the year when they will pay interest to their local banks. Fourth step will be the swapping of interest, and fifth and last step will be the closure of the whole arrangement by swapping back the principals. Those 5 steps will remain as it is, but when it comes to the fourth step where you are reimbursing the interest to the counterparty, who will reimburse how much interest, that has been specifically given over here, and that is why this will have to be done little more carefully. So when I come to that part, I'll give you that complete explanation. So before we plan that swap steps, you should ensure one thing, that swap is beneficial to both the parties or not. So let us first plan the solution for that segment, and then we can go for computing all the benefits while you are recording all the steps of the swap arrangement, that is the currency swap arrangement. So let us focus on how to present the solution over here.
In the solution, you would start with A company's case. So A Inc. or A Incorporation, this company requires to borrow in dollars. It has 2 different options. Option 1, borrow dollars 2 lakh directly at 9% per annum, that will be without swap, and borrow in yen at 5% per annum, and then swap the yen loan against the dollar loan with B Inc. That will be an option with swap. So friends, note down this and then we shall move ahead. Alright friends, let us move ahead and think from the viewpoint of B company or B Inc. So, B Inc., this company requires to borrow in yen. It also has two different options. Option 1, borrow in yen directly at 8% per annum, which we would call as without swap. And option 2, borrow in dollars at 10% per annum and then swap the dollar loan against yen loan with A Inc. And this will be an alternative which we are calling as with swap. So note down this as well, and then we see what is beneficial. Alright friends, after writing this, what you would do is, you would compare. So aggregate interest rate without swap, that will be 9 plus 8, 17%, and aggregate interest rate with swap comes to 15%. So it is clear from this that the swap is beneficial. So write up this as well, and then we move ahead. Alright friends, let us move ahead and write up the calculations and flow of all the events and transactions ahead. So we have again case of two companies A and B. So timing, now borrow in opposite currency. Why we are suggesting to borrow in opposite currency? Because we have just decided that the currency swap arrangement will be beneficial for both. So if you want to borrow in dollars, you better initially borrow in opposite currency, that is yen. So A will borrow in yen at 5%, and it will borrow that much money which is needed by B Inc., or I would say it will borrow an equivalent value of $2 lakhs, which is yen 240 lakhs. On the other side, B Inc. will borrow $2 lakhs. B wants loan in yen, but it will borrow originally $2 lakhs. Now they are going to exchange their principals. So A will pay 2.4 crores yen or yen 240 lakhs to B and receive $2 lakhs, and B will pay $2 lakh to A and receive yen 240 lakhs. End of the year, they will pay interest to their respective banks. So A will pay interest at 5% on 240 lakhs of yen loan, and that will be yen 12 lakhs. What we are doing over here is we are converting all the cash flows of A in equivalent value base in terms of dollars. That is because unlike previous question, here the reimbursement amount is not exactly matching. It is different amount of reimbursement. As a result, what we would do is we would write up all the calculations of A in dollars and convert all the calculations of B in yen. So what B will do is pay interest at 10% on $2 lakh, that will be $20,000. The yen equivalent value will be yen 24 lakhs. Now, of course, the next step will be to exchange the interest. Now, in this regard, the question has given specific instruction of how much of reimbursement will be made. So, when you talk from viewpoint of A company, it is going to receive from B at 6%. So, it will be yen 240 lakhs into 6%, that will be yen 14 lakh 40,000, but the equivalent dollar value of the same is $12,000. Likewise, what will happen with B? B will pay to A the same amount, that is yen 14 lakh 40,000. Now what A will have to pay to B? It is 9% of $2 lakhs, and that will be $18,000, and so B will receive from A $18,000, and B's cash flows we are converting into yen, so that all plus minus calculations in case of B will be made in yen. Now once the exchange of interest is done, we are going to swap back the principals, that is the reversal of this step, correct? So initially when the currency principal amounts have been exchanged, we are now going to make a reversal of this. So we call this step as swap back principals, and what A will do, it will pay $2 lakh to B and receive from B yen 240 lakhs, and what B will do, pay 240 lakhs yen to A and receive from A $2 lakhs. Now once you have finished writing this whole thing, I understand this is a bigger table. I will give you a lot of time to write it down. Once you complete writing this, then we go for the calculation of the mutual benefit to each of the parties. Alright friends, after writing up this, let us move ahead and make up the calculation of the benefit to both the parties. So determining the net result. Interest outflow with swap. So what we are doing is all the outflows and inflows that we have made in the earlier table, we are summarizing those all calculations. So you would see from the A's column that there was an outflow of $10,000, then there was an outflow of $18,000, and there was an inflow of $12,000. Likewise in case of B, both these amounts were outflows and there was an inflow of yen 21,60,000. Finally, the net outflow comes to $16,000 and yen 16,80,000. Interest outflow without swap, A would have borrowed $2 lakh at 9%, so that will be $18,000, and B would have borrowed yen 240 lakhs at 8%, that would be yen 19,20,000. So you may see without swap amounts are higher than the amounts with swap. And finally, we would consider that the swap is beneficial to both the parties. So net savings of interest cost we have identified for A company, it is $2,000, and for B company, it is yen 2,40,000. So note down these calculations as well, and that will be end of the solution.